Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday, November 4th, and today's a big day today. We got the jobs numbers here, so let's kind of go right into it. So the non-farm payrolls for the month of October came in at 161,000, short of the forecast of 175,000. This month was at 191,000. But September and August were actually revised higher by 44,000, so it kind of helps offset the lower number from our forecast here. Now, if you take the average job growth for 2015 and 2016, 2016 had 181,000 new jobs created, whereas 2015 had 229,000. So a little bit shy of average of what we experienced in 2015. So the market hasn't, it's not as hot as it was before, but still going strong here. Unemployment rate for month of October, we had 5% previous month in September. Forecast is at 4.9, and again, it came in at 4.9% here. And last but not least, we got the average hourly earnings here for the month of October. So the previous report back in September was at 0.3%, and figured it would go up again, another 3.3%, and it came in a bit hotter at 0.4%. This is actually a pretty hot number here. So that gives us a year-over-year average hourly earnings at 2.8%, which is a pretty hot number. It's the highest we've seen since the post-credit crisis here. Also, another bit of news going back into the unemployment rate. We had the U6 number, which went from 9.7 down to 9.5, so that got a little bit better. Labor participation had slightly worse, but not, almost about the same. It went from 62.9% down to 62.8%. on there. So let's go ahead and take a look here. The market is up. They definitely like the average hourly earnings that people are making more money. So that means most likely they're going to be spending more money, which will help in turn move the economy a little bit more as well. And of course, we've been fighting inflation. Inflation's been kind of stagnant. This might also help boost inflation a little bit as well. As a result, the market's been a little volatile. S&P's been struggling for 8 days now, and it looks like today could potentially break that 8-day. But a lot of it is concerns about the closeness of the elections for Tuesday. So once we get past these elections, get it present, the market will kind of shake itself out and probably get to where the pricing's at. So just expect a little bit more volatility here, at least for a few more days. At least until after the election, which will be obviously on Tuesday here as a result here. Bond market, as you see, here's the 200-day moving average. We had a nice little bounce up. See, we did touch base on it, but now we're way up. We're about where we left off from yesterday. We did have a nice little extra where we basically closed at zero par, because we closed where we closed. So Thursday closed at the same day where we left off on Wednesday. So basically it was at par, even though we started the morning up. Upwards, and today we're up. So we're up about 9 basis points from where we left off yesterday. We will see better pricing because we didn't get a price for the better yesterday, especially when we started down here. So we will see better pricing today as a result of the late rebound yesterday, and then of course today we continued that a little bit. So this is kind of good news. If you have interest rates out there, you might want to float a little bit, see how much higher we can get. We might, once we get to here, I'd be a little bit more cautious. As it typically, it could push us back down, especially once we get up to the elections and such. All right, folks, so a little bit better pricing today, which is obviously good news. If you guys want to get more updates throughout the day after you watch this video and stuff, I do post updates all the way up to the market close on my Twitter account at Mike Bjork. So if you're interested, just stop on by or follow, and be able to get more updates throughout the day if you'd like to see those. All right, folks, you guys have a great weekend. Hope you guys enjoy yourselves, and we'll see you guys on Monday. Thanks for watching. Bye-bye.